Fed's inflation mission has recession destination and hard landing for stocks. After years of propping up stocks, the Federal Reserve is now confronted with the venture of piercing the wealth bubble to dampen inflation. But deflating the bubble lands the economy in recession, likely forcing the marketplace to shed approximately a fifth of its fee. We consider that the Fed will land us in a recession, Philip Taves, CEO and portfolio manager of Taves Asset Management, advised earlier this week. A recession should tip shares into an common endure market or worst, with losses of approximately 35%, Towers added, pointing to the historical average decline in undergo markets. With markets down approximately 18% year to date, a median bear market decline suggests stocks probably risk losing almost a fifth of their value in a recession. The Fed's fingerprints all over the wealth affect the greater than a decade-long weight loss plan of low-interest fees and market-friendly financial policy situations, in addition to financial stimulus, have pumped up the fee of assets on customer balance sheets, leading to a mountain of wealth that encourages spending and feeds inflation. Growth sectors of the market, together with tech, which were in vogue and often made the listing of the most overcrowded trades for the duration of the fairness bull market run, played a big position in the wealth build-up for equity buyers. When we looked at what the good-sized majority of new customers that got here into our wealth control practice, the FANG shares were a massive chew of their portfolio, Eric Dishon, president and managing director at the Wealth Alliance, stated in a latest interview with. But growth shares with higher valuations have grown to be an increasing number of unattractive in a growing charge environment. I've been pronouncing for the last year, you may very own tech but not in an S&P 500 style, where 5 or 6 shares make up about 25% of your portfolio. Those people are certainly getting hurt right now, Dishon brought. Early signs of Fed policy poking at the wealth bubble. There are early signs that the Fed's coverage measures are setting the squeeze on client wealth. U.S. family wealth shrank for the first time in years inside the first quarter of 2022, a Federal Reserve file on Thursday showed. Household net well worth slipped to $149.3 trillion from an all-time excessive of $149.8 trillion at the cease of ultimate year, in keeping with the Fed's quarterly photo of the countrywide balance sheet. The decline became driven via a $3 trillion slump in stocks, though rising real property values, which climbed by way of some other $1.7 trillion in the quarter, stored a lid on losses. Home expenses, which crowned 20.6% in March from a year in advance, have continued to surge whilst loan costs have climbed, in step with the contemporary S&P CoreLogic Case-Shiller Home Price Index. Deflating the wealth bubble would require a pullback, no longer most effective in inventory prices, however also domestic prices. The Fed supported the markets for about 15 years, but now has an incentive to prick the wealth bubble and cause monetary asset costs and domestic expenses to deflate as a way of addressing inflation, Taves said. Hard landing or crash landing? Undoing the wealth have an effect on, or making customers sense much less well-off to deter spending and bring down inflation may also depend upon the Fed's potential to restore the demand and supply imbalance within the hard work market to chill wage increase. As lengthy as you have faster wage inflation, the Fed received it come near getting anywhere near 2% or 3% inflation, chief strategist at Spouting Rock Asset Management Reese Williams informed in an interview on Friday. While acknowledging the tight labor marketplace is a tough issue for the Fed, Williams said there may be capability that during 2023 that the splendid resignation turns into a remarkable utility, as you're now not going to have such a lot of process openings available. That's already starting to show up. It is concentrated now in blockchain era and software program corporations, a few internet-based businesses. However, it's going to get broader because the 12 months unfolds, Williams brought. As consensus closer to a recession gather steam, many are debating whether or not a deep or moderate economic slowdown is in advance. For a few, the extra household savings built up through the years and absence of essential capital expenditure by means of businesses, will in all likelihood prevent a major recession. We didn't in reality have the mom of all capex spending cycles to generate a whole lot of excess potential, and the purchaser is powerful, Williams said. Those factors are probably what prevents a primary recession.